Hey, and thank you for standing by. At this time, I would like to welcome everyone to the Carlotz for Q20 and FY20 earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during that time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. It is now my pleasure to turn the conference over to Ms. Dawn Frankfort. Ma'am, please go ahead.
Thank you. Good afternoon, everyone. With me on the call is Michael Bohr, co-founder and Chief Executive Officer, and Tom Stoltz, Chief Financial Officer. Before we get started, I would like to remind you of the company's safe harbor language, which I'm sure you're all familiar with. The statements contained in this conference call, which are not historical facts, may be deemed to constitute forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Actual future results may differ materially from those suggested in such statements due to a number of risks and uncertainties, all of which are described in the company's filings with the SEC, which is included in today's press release. If any non-GAAP financial measures is used on this call, a presentation of the most directly comparable GAAP financial measures to this non-GAAP financial measure will be provided as supplemental financial information in our press release. Now, I would like to turn the call over to Michael Bohr, co-founder and Chief Executive Officer of Carlotz.
Thanks, Dawn, and good afternoon, everyone. Thanks for joining Carlotz's first earnings call as a public company. Before discussing our results, let me start by saying how thrilled our team and I are to have completed our merger with Akamar on January 21st, marking the beginning of our next chapter as a public company. We launched our startup 10 years ago in an industry that has for decades been relegated to the punchline of jokes, with a vision to change the way used cars are transacted, to elevate the experience for buyers and sellers alike, and to put the power into the people's hands through our one-of-a-kind consignment model. Over the years, while staying focused on our vision, we've grown geographically, added depth to our team, pioneered the retail remarketing industry by establishing strong relationships with some of the best remarketing clients, and 10 years later, frankly, we feel like we're just getting started. Over the last decade, we have created value for car sellers, car buyers, and our shareholders. And as we look towards the next 10 years, executing with fewer resource constraints and the most experienced and tenacious team this company has ever had, I couldn't be more excited about our future. Before we discuss results, a few quick notes about 2021 that we're most excited about. We expect to open 14 to 16 hubs this year, with 2 already open and 1 opening later this month. This would put us at 22 to 24 hubs by the end of the year, approximately tripling our hub footprint and more than tripling our capacity, since these new hubs are expected to be larger on average than our legacy hubs. Based on these factors and assumptions that Tom will further elaborate, we expect to sell between 18,000 and 20,000 vehicles this year, roughly tripling our vehicles sold over last year. We expect these factors will also result in tripling our 2020 revenue to $335 million to $375 million as we sell more cars and continue improving our F&I performance. In addition to these financial metrics, our strategic goals for 2021 also include adding experienced new teammates, bringing on new commercial accounts, executing a strategic marketing plan, and transforming our technology to greatly enhance our user experience. In short, and to say the least, we expect 2021 to be a transformative year for Carlotz, and we're all feeling the energy and the excitement. With respect to our Q4 and 2020 results, I'll start by reviewing our financial and operational results for the full year 2020, the fourth quarter specifically, and then discuss our strategic initiatives for 2021. Tom will then further discuss our financial results and outlook for 2021. 2020 was a challenging yet very successful year for Carlotz. Despite a disruptive operating environment and unprecedented volatility in the used vehicle supply chain, we accomplished a great deal. A few highlights are as follows. Significant consignment growth. We expanded our volumes with our commercial accounts, which comprised 62% of our business in 2020, up from about 40 to 45% in 2019. We grew our commercial accounts team and expanded strategic sourcing partnerships, in turn driving continued intake of inventory and increasing the number of retail units sold. An ambitious hub strategy. While we didn't open new hubs in 2020, we laid the groundwork for 2021 and beyond through an expansion of our real estate team and capabilities. As a result, we have launched 2 new full-service hubs in Seattle and Orlando, announced the opening of our Nashville hub last week, and just announced an additional Virginia hub in Charlottesville to handle our capacity needs. We also are in advanced stages of securing additional locations, setting us up well for our 2021 hub opening plan, and to continue to grow in 2022. We grew the team. We made strategic senior hires at the executive level and also in real estate, technology, sales operations, marketing, FP&A, growth and development, processing center operations, and of course, dozens of new teammates in our hubs. We signed a merger agreement with Akamar, and shortly after the year end, closed our merger with Akamar and increased our cash by $315 million, which we believe positions us well from a cash perspective for the foreseeable future. All of our hard work over the last 4 quarters led to strong results in 2020. For the year, amidst a pandemic backdrop and without the addition of new hubs, net revenues increased 16% to $119 million from $103 million in 2019, above our projections. This growth was driven by double-digit growth in retail and financing revenues year over year and continued brand maturity in each of our markets. An important driver of this growth was our ability to increase our inventories through our corporate vehicle sourcing partner relationships as demand increased. In addition to revenue outperformance, we sold 6,215 vehicles, also above our previously provided guidance. In terms of profitability, GP dollars and GPU both grew 29% over 2019 to $11.3 million and 1,797 respectively. With respect to fourth quarter performance, results exceeded our expectations on the top line, driven by strong unit growth and continued growth in ASP. Additionally, Q4 gross profit dollars and GPU both grew 25% over 2019, despite the pressure we felt from extended sell-through times resulting from our Q3 and Q4 inventory surge. The additional inventory that we secured to drive our growth put pressure on our processing centers and created a logjam that resulted in slower processing and higher days to sell, which we are remediating through increased staffing, enhanced leadership, and process improvements. As we now look to 2021, we're focused on 5 key drivers of growth. 1, additional hubs. 2, increasing the number of our corporate vehicle sourcing partners. 3, executing our marketing strategy. 4, growing our team. And 5, enhancing and transforming our technology. Starting with expanding our national hub presence. In 2021, we expect to open 14 to 16 hubs, an increase from our previous guidance. The opening of new hubs is the most exciting aspect of our growth strategy because it drives so much of our growth plan. It gives us additional capacity, it spreads our brand to new areas of the country, and it allows us to bring on additional talent to interact with so many new guests. Turning to our next initiative of commercial account growth. This aspect of our growth plan anticipates both growing with existing accounts and adding new commercial accounts. We are keenly focused on this objective as it's obviously important to build the inventory pipeline as we build out our hub network. We have several new pilots in the pipeline from prospective clients in rental, wholesale, fleet management, and other verticals. We believe that these new accounts, when combined with our long-standing relationships with existing accounts, will provide us with a steady stream of among the best, fastest-moving, most attractive vehicles in our markets. In addition to the growth in commercial accounts, as we grow our hub footprint and make our one-of-a-kind consumer consignment to retail model available to more of the population, we anticipate continued growth in consumer consignment volumes. We love being able to provide the benefits of our unique model to the communities in which we operate. In terms of marketing, we've been focused on supporting hub openings by driving leads, increasing web traffic, and introducing our unique business model and brand to new markets all over the U.S. We have seen over 170% increase in leads year over year and over 35% increase in leads per unit. We've seen strong results from our social marketing across all primary channels, including Twitter and Instagram, which saw an increase in followers of over 40% and 20% respectively. We also saw triple-digit increases in our unique users, sessions, and page views on our website, carlotz.com. Which brings me to our next initiative of team growth. Our planned rapid growth over the next several years requires adding teammates from among the best talent in the industry. Talent that we are finding and attracting thanks to our enhanced resources and exciting growth trajectory. Recent key hires include a senior director of operations who's focused on processing center efficiency and the omni-channel guest experience, a director of revenue whose primary responsibilities are inventory management and sell-through, a senior vice president of technology who will work with our CTO on ensuring tight execution of our digital transformation. We've also added senior positions in real estate to continue to build our new hub pipeline into 2022 and beyond. Senior positions in training and development to ensure our new teammates are well trained in the Carlotz way and can deliver the fantastic guest experience that we're known for. We've expanded our recruiting team to help fill all of these new positions, and we're closely monitoring our time to fill in new markets and testing new hiring tools and processes to allow us to quickly hire qualified teammates. From a technology perspective, we are enhancing our entire user experience with a fully redesigned online experience and mobile gateway that will more tightly integrate shipping and logistics, financing, and warranty products. We've found that typically our guests are not only online or only in hub, they usually fall somewhere in between. Our technology transformation plan, as we call it, will provide additional comfort to the guests who previously skewed more in hub to transact more of the journey online, and will drive incremental traffic from those guests who have already made the leap to online only. While we philosophically want the guests to transact exactly how they want to transact, we do believe that by continuing to enhance our technology and the online guest experience, more car buyers will feel comfortable transitioning more of their journey online. Finally, as we just announced last Thursday, we have established a strategic alliance with Ally Financial, a leading digital financial services company and one of the largest full-service operations in the U.S. auto finance industry, to support our national growth efforts. With Ally's support in consumer lending, F&I products, floor plan lending, and remarketing, we believe we will be better positioned to execute on our long-term vision. In conclusion, we are thrilled that through multiple waves of the pandemic and industry disruption, our team drove solid top-line results for the fourth quarter and the year. We are building the hubs, the team, the technology, the marketing plan, and adding commercial accounts, all of which we believe will contribute to revenue and profit growth. Our continued focus on these priorities, combined with our differentiated business model, should position us well to capitalize on our near and long-term growth opportunities. Before turning the call over to Tom, I want to again thank our team of LOTZians for the exceptional job they did this year, continuing to grow and scale the business despite the challenging operating environment. It was amazing to watch the resilience and tenacity of this team that was tested, yet excelled in the face of unprecedented challenges. These are the people that deliver a humanity-focused used car experience that our guests love. We look forward to building on our progress in 2021. I will now turn the call over to Tom to discuss the fourth quarter and full year results and our thoughts around fiscal 2021 in greater detail.
Thank you, Mike, and good afternoon, everyone. Today, I'll focus on the highlights of our fourth quarter and full year performance, and then I will discuss how we are approaching our outlook for 2021. For details regarding our financial results, please refer to our earnings release available on the Investor Relations section of our website. We had a strong end to the year on the top line with fourth quarter revenue growth of 40% to $37 million, exceeding our previously provided guidance range of $31 to $32 million. Unit sales were 1,815, ahead of our expectations of 1,750 to 1,800, and up 12% year over year, all driven in existing hubs without new hub openings. Our revenue growth for the quarter was driven by increases in our retail unit sales, a 22% increase in our average selling price, and a 49% increase in financing and product service contract revenue. With respect to gross profit and GPU, both metrics increased 25%, but were softer than we expected. GPU was $1,546, and gross profit was $2.5 million for the quarter. The pressure we felt, as Mike mentioned, was primarily due to the surge in inventory during the quarter and the resulting lower retail unit profitability as a result of slower sell-throughs and more vehicles wholesaled. Shifting to marketing costs, we ramped up our spend on direct marketing in Q4 to $1.4 million to test the impact of increased marketing on leads and conversions. Total SG&A expenses were $6.4 million compared to $4.7 million in the prior year quarter, with the increase driven by hiring corporate management and support staff to ready for the rapid hub growth in 2021 and some compliance costs associated with the merger and going public. As a result, our net loss was $4.8 million compared to $4.6 million last year, and adjusted EBITDA was a negative $3.9 million compared to a negative $2.6 million a year ago. For the full year, we saw results ahead of expectations in both units sold and total revenue. Revenues increased 16% to $118.6 million from $102.5 million in 2019, despite the impact of COVID-19. This growth was driven by a 19% growth in our retail average selling price and financing and product revenues up 25%. Unit sales were 6,215, which was slightly ahead of guidance at 6,150 to 6,200, and GPU increased 29% to $1,797 within our guidance range. Gross profit increased $2.6 million or 29% to $11.3 million from $8.7 million in 2019, below our guided range as a result of working through the surge in inventory during Q4. SG&A expenses for the year were $17.6 million compared to $18.3 million in 2019, with the year-over-year decrease reflective of our disciplined approach to managing costs during the COVID-19 impacted months, partially offset by the ramp-up in Q4 costs as previously explained. As a result then, our net loss was $8.4 million in 2020 versus net loss of $14.3 million in 2019, and adjusted EBITDA was a negative $6.3 million compared to a negative $9.5 million a year ago. Turning to our balance sheet, we ended the year with cash and cash equivalents of $2.8 million compared to $4.1 million at December 31st, 2019. As you are aware, subsequent to quarter end, we completed the merger transaction with Acamar Partners on January 21st. As a result of the transaction, we raised $315 million in net cash to fund our growth plans for the foreseeable future. Now to discuss our outlook for the first quarter and the year 2021 and some of the factors that will impact our expected results. As we begin 2021, we are excited to have already announced the new hub openings in Seattle, Orlando, and our pending openings in Nashville and Charlottesville, and ongoing negotiations for hub locations in a dozen additional markets. While we had originally planned to open 14 hubs this year, as Mike mentioned, we have increased that plan to 14 to 16. In terms of timing, we are seeing these Q1 and Q2 hub openings push closer to the end of the respective quarters, which has a rolling impact on our full year volume numbers versus our original plan. But the opening of 2 additional hubs should mitigate much of this impact. Also, the timing of the hub openings, coupled with more than doubling the total hubs, will result in the year being back half weighted. As it relates to gross profit, we expect our flow of inventory to better match demand now through the balance of this year, resulting in improving margins as we go through 2021. In the meantime, we expect the higher than ideal inventory levels that we saw earlier this year in our existing hubs to impact our first quarter 2021 gross profit and second quarter to a lesser extent, which impacts our full-year gross profit and GPU guidance. Importantly, despite this impact, we have confidence that we will achieve our GPU outlook for the year. Based on these factors, our outlook for the first quarter is as follows. We expect retail units sold between 1,900 and 2,100, a projected increase of over 30% compared to last year. Next, driven by units sold and higher average selling prices, we expect revenue to be between $42 and $46 million, up more than 65% compared to last year. Gross profit is expected to be between $1.6 and $2 million, negatively impacted by working through excess inventories resulting in larger wholesale losses than we planned. Based on this, we expect retail GPU of $1,300 to $1,500 in the quarter, down from the prior year. Total SG&A expenses for the quarter are expected to be in the range of $17 to $19 million. Given these assumptions, we expect net loss to be in the range of $16 to $15 million. Now moving to the full year 2021 outlook, we expect retail units sold between 18,000 and 20,000, up more than 180% over 2020. The majority of our growth is expected to come from the opening of 14 to 16 new hubs, as we discussed, and our assumptions include inventory sell-through rates that we have experienced in the past for new hubs supported by improved processing times and a greater focus on local marketing efforts. Additionally, we expect that 13,000 to 15,000 retail units will be sold during the last half of this year. These factors are expected to result in revenue of $335 to $375 million, again up more than 180% compared to 2020. Gross profit is expected to be between $30 and $37 million, up over 165% compared to the prior year, and again back half weighted as new hubs open, inventory flow normalizes, and processing times improve, which improves sell-throughs. We expect retail GPU at $1,800 to $2,000, again driven by the improvements just mentioned that will significantly impact the second half of this year. We expect SG&A expenses to be in the range of $107 to $112 million as we make significant investments in people, systems, and marketing to support our rapid growth plan. About a third of these costs are marketing costs, another third are corporate and hub-level payroll costs, and the remaining third are public company expenses, technology costs, and other occupancy and overhead costs. Depreciation expense is expected to range between $3 to $4 million, and our floor plan interest costs are expected to be between $400,000 and $500,000. Again, these assumptions, we expect net loss to be in the range of $87 to $74 million. We also expect our share count to be 113,670,000 for the first quarter and the year. In terms of capital expenditures, we expect our 2021 spend to be $45 to $50 million as we invest in new hubs and new systems to support our rapid growth. Please refer to our press release for all other items related to our outlook. And with that, I'll now turn the call over to the operator to start with questions. Thanks.
Ladies and gentlemen, at this time, if you have any question, please press star, then the number 1 on your telephone keypad. Again, to ask a question, please press star 1 on your telephone keypad. Your first question comes from the line of Sharon Zackfia from William Blair. Your line is now open.
Hi, good afternoon. So a couple of questions on the first quarter, and maybe a deeper explanation of the inventory hangover would be helpful. I think there's probably some confusion given the consignment model as to kind of what happened in the fourth quarter and how that inventory is bleeding into potentially the first quarter and second quarter. And if you could help quantify kind of the build between the 1,300 and 1,500 GPU to the 1,800 to 2,000 for the full year.
Sure. Thanks, Sharon. As you know, we ramped up inventory meaningfully in Q3 and Q4 mostly to enable our strong top-line growth. And much of this ramp was with one specific source of inventory that was giving us the opportunity to take large quantities of very attractive vehicles. We took as much as we could, but we overshot the mark in terms of matching our sourcing volume with our capacity, which logjammed our processing centers. It took a long time for the inventory to hit our website in retail-ready condition, and it left us with a couple of key problems. One, the inventory took so long to get on the site that by the time we got leads and could sell it, we had dropped the price a couple times, which impacted GPU. And two, many of these units aged out per our agreement with our clients, and we had to take wholesale losses as we delisted them. In Q1, we modified the quantity that we're taking in to match more closely with the demand we're seeing from consumers, so the GPU on the units we're now bringing is up. We believe the aged unit issue will largely be behind us shortly, but may bleed slightly into Q2, and our guidance on GPU for the quarter and for the year take this issue into account, and we believe we're still on track to drive considerable GP dollar and GPU growth over last year.
Right. I would add to that, Sharon, just a couple of points. As we work through this excess inventory, a large majority of what we're selling right now is this profit share program. And as we get our inventory levels more in line with where they should be based on the demand in our existing hubs, we'll see the GPU improve pretty substantially on that front. We're also seeing good penetration increases in our F&I products, and so we expect that to continue to improve and improve our overall GPU. And additionally, as we open new hubs, we'll have more centers across the country, so our shipping costs should decrease some. We're working on our reconditioning to do a better job, more efficient job of that, and that we expect that to be an improvement. And we've added some key talent, I think, in the area of our sourcing area of our business, which will help us improve how we acquire vehicles as well.
Thanks. That's helpful. I guess, the corollary question to that, not really knowing contractually how the profit sharing agreements work, is your relationship with this corporate partner okay? Is there any kind of ramifications from what happened with the log jam in the fourth quarter to the longer term potential with this partner?
Yeah, we're in constant communication with our clients, and almost all of them. We have very strong relationships that have been built over years. When we see disruption in the supply chain, we communicate with them as a consultant would with their clients, and so we're aware of the pipeline that they're seeing in their inventory and some of any issues that they may have. If we see retail sales dip for a week or two or a month or two, we communicate that with our clients, and most of our clients are very sophisticated sellers of vehicles, so they understand what's going on in the broader wholesale market, and so we're not having to teach them anything about the retail market. They have been in the industry, in most cases longer than we have, and understand the ebbs and flows in sales and days to sell and lift. So certainly over time, as we work with our clients more, they really begin to learn the benefits of retail remarketing and what it can do for their bottom line. And we have found that, in great times, they applaud with us, and in times when things are a little slower or days to sell slows down, they work with us to minimize the impact of that on both parties.
Good, thanks. And then I guess, it's early days, but is there anything that you've learned yet in Seattle or Orlando that kind of inform your thoughts as you embark on these, the next 12 to 14 hubs that we're expecting this year?
Yeah, we've actually been thrilled with the results at Seattle and Orlando to date. Both of these locations went from us securing the location to opening in under 75 days. Actually, the Orlando hub, or Merritt Island, was a new record for us. We went from lease execution to opening in 39 days. And this speed to execution is super important. It's a direct result of our hub opening playbook that we've developed over the last 10 years, in conjunction with a really talented grand opening team that project manages every aspect of the opening. Opening quickly while we're in this high growth mode really enables us to squeeze extra months into the calendar to sell vehicles, which obviously drives units, revenue, and GP dollars. And also importantly, both the Seattle and the Orlando locations were opened significantly under budget. So we're thrilled with the opening of those two. We're excited about Nashville opening later this month. We just announced a few minutes ago an additional opening in Charlottesville to give us much needed capacity in the Virginia markets. And so frankly, it is the key driver of our growth plan this year is the opening of these new hubs, and we're thrilled with how that's going so far.
Thanks. And then one last question. Obviously, you're planning on roughly tripling revenue this year, so there's going to be a lot of spending behind that implicit in your SG&A guidance. I guess if I was to bucket the SG&A, could you help us all think about kind of how much CAC increases in 21 versus 2020? Because I suspect you'll want to really work on building brand awareness pretty quickly.
Right. In terms of marketing expenses, what we've planned this year is a certain amount for each of the new grand hub openings, and that's a bucket of money that's about $1.5 million per hub opening. And then we've got some just brand advertising that we plan to do, potentially most of that over the second half of the year. So our marketing costs will increase pretty substantially from what we've seen in the past, and that gives us some good confidence that we will be able to drive the units that we've guided to over the course of the year.
Okay, thank you very much.
Thank you. Your next question comes from the line of Karen Short from Barclays. Your line is now open.
Hi, thanks very much. Just wondering, obviously, given you will have a significant increase in number of hubs, how should we think about the average number of vehicles sold per hub as we look at 2021 and beyond? I mean, it's obviously so not lumpy, but 2021 is not really a great year to look at. Any metrics you can give on that? And then I had a couple other questions.
Well, I think for the most part, we want to stick to the guidance that we gave about the overall units that we plan to sell, and again, back half loaded with 13,000 to 15,000 over the last half of the year with these 14 to 16 hub openings. But, basic math would say that you have to do 4 or more cars per day in a hub, and obviously the timing of when these hubs open impacts how many we sell over the balance of the year. And also, it takes a little while for new hubs to ramp up and get to a more mature sell-through rate.
Okay, that's helpful. And then you obviously just gave that SG&A $1.5 million per hub dollar amount, but is there any way you could give a total dollar amount with respect to SG&A increase on all the team member additions, so total annual increase?
I think we'll stick to our guidance of the broad range of SG&A expenses that we gave, 107 to 112 million for the total year, and broke it down into thirds, where marketing was about a third, and some of the personnel costs related to the hubs and to corporate management build being another third.
Okay, and then just last question for me. In terms of the stimulus, I don't know if you can frame how the stimulus might have impacted the January sales, but any thoughts on or color you could provide on that, and then thoughts on the next stimulus that will hit and how you think that could impact sales?
Yeah, we operate in a consumer retail industry, which definitely benefits when the consumer is feeling financially stable, and we see that year after year, specifically around tax refund season. Obviously, we see strong spikes in consumer demand around this time of year. The stimulus that I think started hitting over the last few days and will probably work its way through the system over the next several weeks, we anticipate will be similar to a tax refund season in that it serves to make the consumer feel very financially stable. We think the timing of this stimulus is fortuitous because it comes obviously at the same time as tax refund season, and so we have already started seeing a very strong consumer demand coming from the spring tax season, and we anticipate that the stimulus checks will further that consumer demand and will very likely push it into Q2 as well. So we're feeling very bullish on consumer demand for our product over Q1 and Q2.
Great. Thanks very much.
Thanks, Karen.
Thank you. Your next question comes from the line of Emmanuel Rosner from Deutsche Bank. Your line is now open.
Hi, good evening, everybody.
Hi, Emmanuel.
Hey.
So I wanted to ask you about some of the near-term hub opening for the first quarter and the second quarter, and I think you were mentioning that those would be maybe back-end loaded inside the quarter. What needs to happen operationally still, for these to happen? Just give us a sense of what the process is like and sort of like the confidence in the near term.
Yeah. So we've got a very, very extensive hub opening playbook, but I'll simplify it dramatically. We need to secure the location. We then need to ensure that we have zoning and permitting. We simultaneously seek to hire the team that will run the hub, and then around the time we're doing that, we do all the physical plant improvements and upgrades to make sure that the hub is in great shape when it's time to open. And then within a few weeks of our scheduled opening date, we either bring in inventory from some of our other hubs, or we purchase some inventory to, we call it stocking the pond before the hub opens. And so, we've been doing this for 10 years, and I've kind of simplified the plan and made it sound easy. It's not easy. There are difficulties, at every stage. There could be a zoning issue that pushes us back a few weeks or a few months. It could be more difficult to hire the right general manager for a hub. We could have an abundance of inventory in one market and not as much as we'd like in another. And so there are kind of like micro issues that pop up as we seek to expand these hubs, but they're issues that we've dealt with and solved over the last 10 years. So what we like is the issues that are in our hands, like hiring and getting inventory. What we dislike is the issues that aren't in our hands, like zoning and permitting. And so far as we think through the facilities that we're thinking about for our next several hubs, zoning and permitting is probably more complicated than we'd like in one or two of the locations. And then the rest seem to be ones that we feel very confident in. What's important to note about our hub pipeline is that it constantly changes until we have these locations secured. So, Tom had mentioned that the hub pipeline is full for the ones that we'd like to open in 2021, but in reality, likely a few of them will fall off for one reason or another, and more will come on. And within the next quarter or two, we'll probably start seeing the hub pipeline being filled with hubs that we anticipate for 2022. So it's a fluid process, and we, so far, the execution on our side has been excellent, thanks to the talent we have on the teams that focus there, and we're confident that will continue throughout the year.
Okay, great. And then what is the latest on your vehicle sourcing volume? It seems maybe 2021 should be somewhat locked in. Is that the case? And then what kind of volume do you need for 2022?
Yeah, so inventory is obviously dynamic, not static. It goes up and down based on the rate of sourcing and the rate of sales. So we definitely don't lock in inventory for the year. We are constantly working with our clients to source the amount of inventory we need. As we grow, we're in constant communication with our clients, by location, letting them know, hey, we might be opening in city ABC, and so let's start thinking about inventory in that market that could come there. I've used the analogy many times that our business is like a sink. The cars we source are akin to water coming from the faucet, and the cars we sell are water going down the drain, and then our hubs or our website is the sink. It holds the water until it goes down the drain. So in an ideal world, the faucet would know exactly the rate of the drain flow and match it perfectly, but that never happens, partly because there's a process to getting the water into the sink, but once it's in the sink, it can flow down the drain very quickly. So during periods where we see strong sales, we'll definitely see inventory drop, like we have over the last week or two. And when we see spikes in sourcing, inventory can peak, and our job is really to try to match up the faucet and the drain as well as we can. Today, our inventory, as I mentioned, is lower than the peaks we saw earlier this year, which is reflective of the sales momentum that we've seen over the last few weeks, but we anticipate that our inventory will modulate back to the peak numbers as spring selling season runs its course.
Okay. And then this bigger picture, are you seeing any changes in the competitive dynamics for sourcing inventory? Anything that's been changing? I mean, not specifically this quarter, but I guess over the recent months, a year.
In terms of, we look at it less in terms of competitive dynamics and more in terms of what's going on in the broader industry. When wholesale prices are very, very high, our clients tend to revert to selling more vehicles at wholesale than retail. We saw that for a few months in mid-2020 as the pandemic really kind of shook the used vehicle supply chain, and so we then shifted from certain types of accounts that are more impacted by the wholesale market to accounts that are less impacted by the wholesale market. So we transition that way. We are seeing very strong wholesale prices right now, and so we're continuing to work with our clients to ensure that they recognize the value of retail remarketing, and we want to make sure that we can maximize the return they get on their sales. In terms of retail remarketing, we don't see anybody doing what we do. So from a pure competition of perhaps some of the other retailers you're thinking of, we don't see anything there. We look at it more as we're competing with the alternatives in the industry, and so we monitor that closely.
Great. Thank you so much.
Thank you.
Thank you. And your next question comes from the line of Seth Basham from Wedbush Securities. Your line is now open.
Thanks a lot, and good afternoon, and congrats on your first publicly traded quarter.
Thanks,
so my first question is around the aged inventory that you talked to. So is there aged out inventory risk going forward with this certain partner or others? And if so, how do you manage that a little bit better going forward?
Yeah, great question. Each one of our clients has different requirements or desires in terms of speed of sale. There are some of our clients that demand or really require the vehicle to be sold in 30 to 45 days. That's kind of the tightest schedule we're typically given. For those clients, we price aggressively right out of the gate to make sure that we sell as many of those at retail as possible. We also need to make sure our processing systems are working as they should to get those vehicles on the lot as quickly as possible. We have other accounts that they own the inventory. They're much more focused on lift, which is the amount that we get them over wholesale. They're much more focused on lift than they are on days to sell. So those accounts give us a lot more flexibility in terms of timing. And then many in between. So the accounts that led to the issue that we had with timing were somewhere in between, and we ultimately really just took too many of their units, and not necessarily too many to sell. If we had unlimited time, we're selling cars like crazy right now, so we would have loved to have a bunch of those that ultimately timed out. But because they took much longer than they should have or than they typically do to work through our processing center, they ended up not hitting the website till, in some cases, 30, 40 plus days from when they showed up. And so at that point, we're a little hamstrung on being able to sell it in an amount of time that's acceptable to them. And so ultimately we have to delist many more than we wanted to. Going forward, we've spent a lot of time. We've hired senior people into the team to really focus on processing center efficiency and ensuring that we get back to, kind of pre-pandemic or pre-inventory surge speed at the processing center. And we're also working with, new processes, new equipment, additional human resources, to ensure that when we get these spikes in inventory, that we're able to process them quickly and not end up hitting the back end of these consignment periods as frequently as we did in resulting from our Q3 and Q4 inventory surge. There will always be vehicles that, frankly, for reasons that we can't predict, won't sell in a period, and our job is to ensure that happens as little as possible, because those really do impact GP dollars and GPU, and so that's what we're focused on.
Got it. That's helpful perspective. And just thinking about the types of corporate sourcing relationship partners you have going forward, do you expect them, the ones that are profit sharing related, to make up a larger or smaller percentage of your units that you sell going forward?
Hard to say. We don't. When we're thinking about inventory, we always just look for the best, most sellable, what we think is the most fast-moving inventory, and we have several different, pricing arrangements with our clients. One of which is the profit share, one that we call a backstop program, and one is the flat fee model. And we really look at the quality, the sellability of the inventory more than we look at the model. The models are essentially designed to produce the same results if we're operating the right way, and if they're not producing results, then we'll take that into account. Or if they're not producing the same results, then we'll take that into account. But we typically want to put the inventory that we think is the most sellable in front of our car buyers, and whether that be one type of model or another, remains to be seen. So we don't really select inventory based on the type of fee arrangement we have with our client.
Got it. Understood. And you referenced strong wholesale pricing currently. What are you seeing from a retail price standpoint, and what are the implications of that from a selling margin perspective, putting aside the inventory surge issue?
Yeah, we've always found that the two are related, and so obviously the reason wholesale prices increase is because there's a retailer who's trying to get another unit on the lot or on their website, and with fewer units, they're willing to pay more. But when they pay more, they need to continue to make their margin, so they charge more. And so we've seen that the retail market and the wholesale market move in tandem pretty well, which begs the question: why does the pricing of the wholesale market impact us at all? It does, because many of our clients kind of look at the wholesale market as the great equalizer. If they can get great wholesale returns on a vehicle that they're holding on their books for X dollars, and they can do it quickly, they might do that, despite the fact that there's still a tremendous lift to having that vehicle sold at retail. And so we typically see much greater spikes in consignment volumes when the wholesale market is normalized or even depressed, and we see our accounts may be wholesaling more than retail when the wholesale prices are up, even though we've seen that wholesale and retail prices generally move in tandem. So as a result of wholesale prices being up, as we've all read about in the market and that we've seen, retail prices are very healthy as well.
Got it. Okay, last question, and I'll turn it over. Is just thinking about your outlook for 2021 from a gross profit standpoint. It seems like your implied gross profit guidance is a little bit lower than you communicated in January. Is there anything else besides the inventory surge issue impacting that, the one that you mentioned in the first quarter? Thank you.
No, I don't think so. I think it's primarily the surge in inventory. Also, to a certain extent, a little bit slower opening of new hubs in the first half of the year than we originally planned, and all that's leading it to be a little more back half weighted.
Very good. Thanks again, and good luck.
Thanks, Seth.
Thanks.
Your last question comes from the line of Daniel Powell from Goldman Sachs. Your line is now open. Mr. Daniel Powell from Goldman Sachs, your line is now open. Please go ahead. Mr. Powell, your line is now open. Please go ahead. Mr. Daniel Powell from Goldman Sachs, your line is now open.
Yeah, it sounds like we lost him. So
yeah. Are there any other questions?
All right. There are no further questions at this time. This concludes our question and answer session. I would now like to turn back the call over to Mr. Michael Bohr, CEO, for any closing remarks.
Thank you, and thanks to everyone who dialed in today. We are at the launching pad of this very exciting journey to dramatically change the way people buy and sell used cars. We are excited about the opportunity in front of us to execute our nationwide growth plan, and we believe that we have the unique business model, team in place and growing, hub pipeline full, technology transformation initiative underway, strong and growing client base, marketing plan, and the financial resources available to enable all this growth. We view our debut as a public company as a new and exciting beginning. And as we gaze forward to see the opportunity ahead and the successful businesses that we compete against, we're thrilled to be part of the movement that is bringing the used car industry out of its corner and away from punchlines into the spotlight of customer-centric industries transforming, evolving, and growing. We look forward to speaking to all of you again shortly. Thanks, and have a great evening.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation. You may now disconnect.